What if the Fed doesn't cut rates this year? As recently as 12 months ago, everybody was expecting rate cuts by now. And during the course of the year 2024, there were going to be maybe 3 or 4 or 5 or 6 of them. And here we are in the month of May and haven't seen those rate cuts, nor does it look likely that they may in fact occur at all during the course of the year. So what's going to be the impact on your money in that particular situation? Plus, of course, we're going to break down some recent headlines involving corporate earnings and inflation, and most importantly, how those affect your money. Of course, on the program this week, we would be remiss if we did not start out the program wishing all of the mothers out there a happy Mother's Day. We hope you enjoy the day, get treated well by your offspring. Certainly a happy Mother's Day goes out to Stephanie, my wife, mother of my 3 sons. Sadly, it's one of those Mother's Days at the Garris household where there aren't any of the sons in town. One of them is working full-time up in Indiana. The other is doing an internship in California. And then the third one is also finishing up his year at UVA. So sadly, we are an over Mother's Day from my wife's perspective. So that's unfortunate, but I know they sent cards because I made sure that we had 3 that were received prior to today. And of course, certainly a happy Mother's Day to my mother, Jane, Stephanie's mother, June, as well. So hope you take the time to spend some time with your mother, and happy Mother's Day out there to all of the great moms out there. You do so much to get these kids raised, and then you raise them and you realize job ain't done. So it's a lifetime commitment, if you will. So thank you for all that you do. Welcome on in, of course, to Dollars and Cents. We are a radio program and podcast that helps you make sense out of all of life's decisions involving your dollars. One of Central Florida's longest running radio programs, also a top 25 financial planning podcast on the big wide world web. If you would like to connect with us on any of those favorite podcast platforms that you belong to, make sure you check out our channel, Nelson Financial Planning. Any trouble finding our channel on your particular podcast platform, we encourage you to go to our website, Nelson Financial Planning. There you'll see the icons, click on them, and it will get you immediately connected to our channel, including our channel over on YouTube as well, where you get to see us doing the show in all of the video glory. My name, of course, is Joel Garris. I'm a certified financial planner, certified financial fiduciary at Nelson Financial Planning. Had the pleasure of the past couple of weeks having other folks on the team join me. Last week it was Chet Coward, our newest certified financial fiduciary. Week before that it was Christina Lamb, our longtime certified financial fiduciary and also part of our tax team as well, being an IRS enrolled agent. Feel free to check out our website, Nelson Financial Planning, to learn more about how we can help you improve your life with a successful and cost-effective financial plan. So let's get to those headlines, shall we? And how they impact your money. There's certainly a lot going on right now between earnings season and in inflation. So let's start with earnings season because that is kind of top of mind given where we are right now in the calendar. As you might well expect, the ability of a business to earn money directly impacts its valuation, right? So there is a direct correlation over time between whether businesses are making money, earning money, and how well your investments perform, right? That would make sense, right? Direct correlation almost on that over a extended period of time. And when we talk about earnings season, that is the time of year, it happens 4 times during the course of the year, where companies announce their official results for the most recent quarter. So right now, we're kind of at the tail end of earnings season for the first quarter of 2024. So how's good old corporate America doing? Well, bottom line, based on the results so far, and we would almost argue that the vast majority of the results are in for corporate America, since at this point, north of 85% of those publicly traded companies in the S&P 500 have already reported. So you got most of the earnings out of the way. It really is kind of getting to the end of earnings season when folks announce those results for the first quarter. 85% have reported. At this point, the earnings announcements have generally come in better than expected. In fact, 80% of those earnings announcements actually beat expectations. So when that happens, usually that spells good news for the markets. In fact, if you drill down a little bit more, earnings growth picked up on a per share basis, up over 5% versus a year ago. And that also was better than the expected roughly 3.5% increase that analysts expected at the end of March. So going into earnings season, end of March, end of the first quarter, the expectation was to see earnings growth at around 3.4%. It actually has wound up being over 5% at 5.2. So as you might well expect, hey, those are better results than what was originally expected. Putting the market for the past several days here, or through the week, there was a string of several days where the Dow itself was positive, and ultimately that was the sort of the longest winning streak so far this year for 2024. So obviously the market responded, particularly in the short term as these earnings were coming out, particularly the bulk of earnings season. And as you know, that obviously spells good news, right? For your 401ks, your IRAs, your non-qualified after-tax accounts. So I guess bottom line on all of that is that if you're spending your time and focusing on your investment strategy while you're kind of wringing your hands a little bit about the headlines or the upcoming presidential election, you may be better served by looking at your underlying asset allocation to make sure you have a heavy dose of those large U.S.-based companies. The reality is that earnings season sort of that is concluding for the first quarter of this year, once again sort of underscoring the fact that those types of companies remain sort of the main drivers of the global economy. And that's one of the biggest reasons why we are offering sort of that free portfolio analysis you've had us talk about to help you see what your specific asset mix is. What types of companies do you actually own? It's not enough to just say, oh, I own X% stocks, Y% bonds, and Z% cash, but you really got to drill down and see, okay, well, what is it that I own on the stock side to make sure that you don't have any issues in terms of that underlying portfolio diversification, or even worse, and we've certainly been seeing a lot of this lately, where you're paying a too high of a cost for the investment advice that you are getting, or in some really bad cases, you're not even necessarily getting good investment advice. So make sure you visit our website, nelsonfinancialplanning.com, to request that absolutely free portfolio diversification and cost analysis that we are offering. We're going to return after these messages here on Dollars and Cents with Joel Garris of Nelson Financial Planning. Another busy week at Nelson Financial Planning. This past week, we did our annual Shred event, which was pretty neat because we actually typically have reserved that just for our clients, but decided to make it more of a community-based event. And it was really neat to see the office put it out on places like Nextdoor and Eventbrite. And so the number of folks that showed up from the community at large was really pretty neat, and certainly it was our pleasure to help them shred their various documents. We almost filled up a full truck within a 3-hour period of time, so certainly we were very pleased to be able to help the community at large, along with our clients, help to protect their identity. My goodness, we certainly talk a lot about that on the program, some of the things that you can do to avoid identity theft and being taken advantage of from all the scams that are out there online. It just never ceases and never stops. So make sure that when you are disposing of your personal information, that you take the time to try and dispose of it properly. Certainly, that Shred Day that we did this past week had a huge outpouring of support from the community, and even gave out coffee and donuts. And then, of course, let's not forget, we also gave out free copies of our book, Next Gen Dollars and Cents. Still available on Amazon at $14.99, but generally, if you call the office, schedule an initial consultation, we'll give you one for free when you come on in. Or if you came to our Shred Day, you'd also been able to grab a copy of it. Certainly, we encourage that. The book, after all, designed to explain some of the essential tools and strategies that you need, and really people of all ages. We refer to it as Next Gen Dollars and Cents, but it really is for all ages, because if you've got someone, if you've got 90-year-old parents and you're in your 60s, you're about ready to become the next generation when something happens to them. So what are you going to do when you have to clean up an estate or figure out some of those problems of inheriting money? So the concept is to provide all age groups, because let's face it, we're all the next gen at some point in our lives. And so the book is designed to talk about a host of those kinds of topics as well throughout the program that we do here on the radio as well. A lot of the topics that we've talked about on the program over the years made for interesting chapters in the book. Of course, one of the things that we talk about in the book, which is a good segue to our next topic here on the program, Dollars and Cents, is inflation. Clearly, inflation has a direct impact on your money. It's everywhere. And the cumulative impact, particularly over the course of the past 3 years, is roughly around 20% when you kind of do the math. That's probably even on the low side, some might argue. And certainly we're going to talk about inflation more later in the program after we talk about some of the things about the story, what happens if the Fed doesn't cut interest rates this year. But one of the easiest sort of examples that we've always used in the office, although I don't think we used it in the book. Maybe on the next edition we'll have to use it on the book. But one of the things that we always use as an example for inflation is the simple postage stamp, right? And if you recall what that is, that's a thing that you put in the upper right-hand corner on the outside of an envelope that basically pays for that envelope to get transported from point A to point B. For those of you who haven't sent a letter out in a while, and obviously that's probably a lot of people because less people mail stuff, but a postage stamp. That's the thing that goes on the outside of the envelope that pays for that delivery. And the postage stamp in and of itself is a good example or a good reflection of the impact of inflation, right? When I was born in 1970, the price of a postage stamp was 6 cents. By 1990, it had moved up to 25 cents within that 20-year period of time. Fast forward about 10 years later, it shifted to 37 cents. By 2008, it was 42 cents. 2014, it had gone to 49 cents. So as you can see, okay, yeah, that's kind of what inflation represents. All of a sudden, your dollars don't buy as much as they used to. That's the core negative, if you will, of inflationary sort of incendiary impact, because it does kind of burn up the value of those dollars. So unfortunately, I guess this is a sign of the times in terms of the greater conversation about inflation. A month ago, the U.S. Postal Service filed a notice to increase the price of a stamp from 68 cents. Yes, that's how much a stamp, first-class postage stamp, costs these days. They filed notice to increase that by another 5 cents from 68 cents to 73 cents. That would be the second increase this year and the fourth since the start of 2023. If approved, the price of a postage stamp would have increased by 33% over the course of just the past 4 years. Folks, that's inflation, right? And the cost, once that's in the books, right, or as we like to comment on the program, in the soup, is kind of always going to be there going forward, right? It never really disappears. And that's the continued drag of inflation. So from your money's perspective, right, you need to always make sure that there's some portion of your portfolio that's got to have some growth to help offset the impact of inflation. And the reality is that's effectively at any age, particularly if you're retiring and you think you need to eliminate growth from your portfolio. That doesn't make any sense. I mean, if you're retiring in your 60s, a married couple, good Lord willing, the actuarial tables would say that one of you is going to be around at least 20 or 25 years. So that really underscores the need to be able to have some growth on a regular basis. And the other thing I think people that get a little confused on this is that at the end of the day, you're not going to use your entire portfolio at a single time. And I think people get caught up in this notion of, I got to have a huge part of my portfolio now shift to the more conservative side. And our view on that is, well, you're not going to use the whole thing within a couple of years. Or, I mean, if you are, then you probably should have saved more for your retirement if you're just going to bleed it dry within the first couple of years of retiring. No, you spent a lifetime, decades spent saving money over time that you're now going to spend over the course of decades as well. And so when you think of it that way, certainly you want to have different parts of your portfolio doing different things at different times. I mean, that's kind of the very definition of diversification. But how that translates to in practice is that if the market isn't behaving, well, okay, then you take it out of the more conservative cash or bond side of the portfolio. And if the market is behaving, then you take it out of the stock side. You should be constantly looking for those opportunities to sort of shift around where your income is coming from to take advantage of when things are good, but at the same point in time to be smart when things aren't good, to take it out of that side of the investment equation that hasn't gone down as much as other parts. That's the whole reason why you have kind of that diversification. No matter the headlines, you should certainly be able to make sure that you wind up having parts of the portfolio that you can use at any point in time, regardless of the headlines. Well, we're going to take a break. Coming up next, we're going to talk about a little bit about those rate cuts that aren't coming and what's the impact on your portfolio. So stay tuned through the break here on Dollars and Cents with Joel Garris of Nelson Financial Planning. So 12 months ago, everybody was expecting a number of rate cuts during the course of 2024. Do you remember all that far back, right? There was a lot of folks predicting 5, 6 rate cuts during the course of 2024. And here we are, not quite at the halfway point, but coming up pretty close. The reality is that there haven't been any, nor is there really much conversation about those rate cuts being anytime soon. And it's interesting because that expectation of where we thought rates were going to be 12 months ago, even 6 months ago, there was a lot of folks predicting that there would be 3 or 4 different rate cuts here at the start of the year when the year started. The reality is that now it doesn't look like there's going to be hardly anywhere near that number. I think maybe one, and emphasis on maybe, because the other part of it, as we've said on this program before, the closer you get to a presidential election, the less likely that they're going to want to cut rates around that timing. So I guess it begs the question, what if the Fed doesn't cut interest rate? What's going to be the impact on your money? And how do you need to sort of prepare for that higher for longer type of an environment that we're looking at in terms of interest rates? Well, we'll answer that question on this segment of this week's episodes of Dollars and Cents, where we help you make sense out of all of life's decisions involving your dollars. One of Central Florida's longest running radio programs celebrated our 40th anniversary as a business earlier this month. Ultimately, we're one of the longest running radio programs as well, and a top 25 financial planning podcast on the World Wide Web. So make sure you check out our website, nelsonfinancialplanning.com. Once you're there, you can schedule a free conversation so that we can help you improve your life with a successful and cost-effective financial plan. My name, of course, is Joel Garris. I'm a certified financial planner, certified financial fiduciary at Nelson Financial Planning, where we got a team of great people who also happen to be certified financial fiduciaries as well that stand ready to help you at any point in time. So I guess one of the chief benefits of higher interest rates is that if you've taken the time to shop around your cash, right? So your emergency savings, your cash money, you actually should be earning some interest on that, assuming that you have taken the time to kind of shop it around. If you haven't taken the time to shop around and you left it kind of sitting at your bank, then you aren't probably really earning anything, which would be a problem. You still want to make sure you're checking that out in terms of what you're actually earning in terms of that cash and savings at your bank, because clearly, depending upon where you put that cash, it's actually earning interest. But again, based predominantly on what the overnight lending rates are in terms of those Fed interest rates. So that's a clear benefit of if rates are higher for longer, then you're going to continue to earn a higher level of interest rate on those savings. On the flip side, if you will, unfortunately, that means that mortgage rates will probably stay in the 6 or 7% neighborhood. The reality is, though, that that's somewhat in line with sort of historical averages, so not that dramatically out of line. If you talk to anybody that had a mortgage in the early 80s, they'll tell you about 13, 14%. Those rates would certainly be very high indeed. But they also gives you some historical perspective of where rates are now relative to kind of where they've been over an extended period of time. Of course, the issue with higher rates, right? I mean, increasing rates, having interest rates higher is ultimately the economic impact is that it's intended to slow economic growth, right? We all kind of know that basic correlation of the Fed raises rates when it wants to slow down economic growth to prevent an economy from overheating, to prevent inflation from running rampant. On the flip side, the Fed starts to cut rates when they want to sort of hit the gas economically, to encourage economic spending, economic development. All of that translates to when they sort of reduce rates or cut rates. The reality is, though, the U.S.'s economy has proven pretty resilient against the backdrop that we are in terms of the current interest rate environment. In fact, you could certainly argue that the U.S. results have been incredibly strong, especially in comparison to the rest of the world. The prediction economically for the U.S. economy for the calendar year 2024 is the growth expectation is 2 times and in some cases 3 times greater than what major developed countries in the rest of the world are expected to do during the course of the year. If you think of the U.S. economy expected to grow at around 2.7%, the flip side of that is that the European economy only expected to grow 0.8, less than 1%, and the Japanese economy expected to grow 0.9%. So U.S. economy growing at almost 2, actually 3x what those other major developed economies are doing. Clearly, the U.S. economy is showing some resilience in the current interest rate climate. Obviously, main drivers are consumer spending, manufacturing investment, things like that. But it's hard to ignore that progress on inflation is, in fact, stalling a little bit. It's sort of been stuck at 3% over the course of the past few months. The goal of the Federal Reserve is to try and get it down to 2%. We think that's going to be pretty hard. If you look historically at inflation, it's kind of averaged a little bit closer to the 3%, not the 2%. So that might really be hard to do that. And of course, if you start to cut rates, right, then you run the risk of increasing inflation. So the Fed is sort of continuing to sort of sit pat because that inflation piece is certainly not what it's desired to be, but economically, and certainly corporate earnings, as we were talking about earlier in the program, seem to all be hanging in there decently enough. The impact of inflation cannot be ignored. It is real. We talked about that postage stamp example earlier in the show. Fast food, another example. Since September, I was reading a statistic where since September, fast food, fast casual restaurants have increased prices by as much as 10% on average just in the course of just since September. Some areas, particularly say California, where they're trying to institute a $20 minimum wage, or they're in the process of instituting it, the inflation has been even more dramatic. My son Connor, who is doing an internship out in Los Angeles right now, can certainly tell you that his tacos cost more now than they did when he first arrived in Los Angeles. So it is certainly a pretty significant impact that inflation is having. And that's why I think the Federal Reserve, more likely than not, to not cut rates, because when you cut rates, you run the risk of spurring economic activity and increasing inflation. So probably going to continue to stand pat, if you will. As we said earlier in the program, the reality is that the financial markets have sort of kept up with all of that pretty decently and haven't necessarily been thrown off by these higher interest rates. Even now, as we were saying earlier, the Dow has experienced the kind of the longest winning streak of the year so far in 2024. The broader markets have certainly hit a series of record highs during the course of this year so far, even against the backdrop of those increasing Middle Eastern tendencies. Historically, we're in that period where stocks have, in fact, historically done well, kind of following that pause of increasing rates. So if you think of where we are in the cycle, they're no longer raising rates, but they haven't started cutting rates. And it's that interim period of time where you actually have a market performance that's relatively decent. So when we return from the break, we're going to kind of break that piece of the cycle, the economic cycle, down and what it means for your money. So stay tuned through the break, and we will continue here on Dollars and Cents, where we help you make sense out of all of life's decisions involving your dollars. My name, of course, is Joel Garris. I'm a certified financial planner, certified financial fiduciary at Nelson Financial Planning. Stay with us through the break when we continue here on Dollars and Cents. So talking about that period of time of sort of where we are right now in terms of when we think about the Federal Reserve and interest rates and where we are in kind of that cycle, right? So we're sitting in that period of time where the Federal Reserve has gone through a period of raising rates, right? That's what they were doing through most of last year. But they haven't quite kind of switched stripes, right? So they haven't started cutting rates. So we're in that kind of interim period of time where not necessarily raising rates anymore, but they're kind of taking a wait and see approach before they start to go the other way. And what's interesting about that period of time is it's actually a period of time where both stocks and bonds historically have a track record of doing quite well during sort of that transition period of time. If you look at the prior 4 rate cycles in that, kind of that 2-year window, which is usually the window between when you stop raising rates until you get to the point where you're cutting rates, the average return in the S&P 500 north of 11%. Bonds did relatively well as well, up about 8.5%, which is pretty good for the bond side of the equation. And we're sort of less than a year in that phase. So, and that certainly seems to be kind of the timing that we might very well be on in terms of when you would start to see the Fed begin to cut rates, because again, the stubbornness of inflation and still continuing to remain at around that 3%. So still about halfway through that cycle. And so when you think about on a historical basis, these rates that we're seeing are certainly not extreme, much higher than where they were sort of 3 years ago, granted, but comparatively in line with historical elements. So, or historical track records. So, I think the conclusion is that even though the Fed is not cutting rates at the pace that everybody widely expected just a few months ago, things appear to be resilient enough, certainly when we look at most recent earnings season that is in the process of wrapping up for the first quarter of this year, where you've got corporate earnings that continue to do well, and it seems like the markets and the economy are able to kind of absorb rates where they are at, which gives the Federal Reserve the opportunity to kind of continue to stand pat and see how things play out. What it means for your money is that you're very much in the period of time where that transitory period between when they stop raising rates but before they start reducing rates actually historically has proven to be a good time for the markets. So certainly something that you want to keep in mind when you're looking at your overall investment allocation. And as we said earlier in the program, maybe stop wringing your hands excessively over the headlines and what also is coming up here in November with a presidential election. The reality is that rates and the economy and corporate earnings and inflation still seem to be all percolating along decently enough where you would not expect any dramatic movements one way or the other. So make sure you maintain consistency in that investment allocation that you've created. Hopefully that's one that is a heavy dose of predominantly large U.S. companies. Those continue to be, let's face it, the main driver of economic growth globally. And certainly when you think about those statistics that we were sharing earlier about expected economic growth in the U.S., expected to be 3 times greater than what they're going to see in Europe this year or what they're going to see in Japan this year. So pretty dramatic in terms of the difference in the economic climate. This is Dollars and Cents, where we help you make sense out of all of life's decisions involving your dollars. My name, of course, is Joel Garris, certified financial planner, certified financial fiduciary at Nelson Financial Planning. Lastly, we want to talk about here on the program, not sure if you saw this statistic or not, but more people elected to file an extension on their tax return than ever before. So I guess we're turning more and more into a nation of procrastinators. I think some of that is that a lot of the forms are slow to get generated, right? The more unique forms that you might have that are feeding into your tax return, K-1s or business returns or any of those kinds of things, we're seeing that the processing of those or the production of those is much slower than it was, say, 10 years ago. And so that could be forcing more people to be on an extension rather than just sheer procrastination. Hopefully it's not that. Taking an extension is fine with one big giant caveat when it comes to your taxes. And this is particularly important because the numbers really have jumped. According to the IRS, 19.4 million, or about 13%, of taxpayers out of the expected 146 million taxpayers out there requested an extension. That is in fact a significant jump, a jump of about 55% from just 10 years ago when there was only 12.5 million extensions filed. And again, no harm in filing an extension, but the problem is that before you elect to hit that extension button, you need to understand that it doesn't toll the amount that you owe. It's not like you get an extra period of time to pay it. I guess in theory you do, but, and here's the big giant caveat, if you owe money, then there's a failure to pay timely penalty along with interest that in today's interest rate environment winds up being 8%. Yes, 8% is how much you're going to pay. So you're still going to have to pay, and you're still going to have to pay what you owe. You're not going to get out of that if you're on an extension. But not only will you need to pay what you owe, but you're going to have to pay even more because of that interest rate and those penalties. So it certainly gets kind of pricey. So if you're one of those folks that have kind of taken the extension simply because you've been procrastinating, you really might want to just hustle up and get organized and get your tax return done because at the end of the day, you are, in fact, increasing your cost on a going forward basis. And you certainly don't want to do that in any way, shape, or form because that can wind up being incredibly expensive and much more costly than just what you owe on your particular tax bill. That is pretty dramatic one way or the other because it really is increasing that cost. And it surprises people because, at 8%, the reality is that that's a much higher interest rate than what we've seen for a number of years. Not more than 2 years ago, the interest rate on that was 4%. Obviously, 4%, a little bit more palatable of an interest rate than all the way up to 8%. So if you're on extension, take the time this week to get organized and get those taxes filed, particularly if you owe money, because you're going to find that you're going to owe a lot more money by taking that extension. Well, I wanted to just take a moment here at the end of the show, along with what we did at the beginning of the show, to wish all of the mothers out there a very happy Mother's Day. Happy Mother's Day to my wife, Stephanie, and happy Mother's Day to my mom, Jane, and to my mother-in-law, June. I know we'll have a fun day in front of us and get to enjoy a day set aside to recognize all the moms out there. So happy Mother's Day to all of the mothers out there. If you like what you heard on this week's program, or you want to learn more, don't hesitate to reach out to us. As we say on the program, we have a wide range of topics of which we talk about here on the program. Chances are we've probably hit it at some point over the course of the past 35 plus years of this program, but maybe there's a topic that you'd like to hear from us about. So don't hesitate to reach out to us, courtesy of our website, Nelson Financial Planning, and let us know if there's something that you'd like to hear us discuss on dollars and cents. With that, we're going to wrap it on up and get on out of here. Thank you all for listening to this week's program. My name is Joel Garris of Nelson Financial Planning. Enjoy the rest of your day.